Thank you for coming in after lunch. So I'm Chris Burniske. I am a partner at Placeholder, and I'm co-author of Cryptoassets, which you just heard about. And today I'm going to be talking about cryptoasset valuations, something near and dear to my heart, and something that I got started on at the end of 2014, actually, at ARK, when Grayscale approached ARK about the Bitcoin Investment Trust and potentially putting Bitcoin into publicly managed funds. Of course, ARK being a registered investment advisor required that we really understand the operating metrics, the security model, the potential for future appreciation of Bitcoin, which really got me started on the valuation path. Reflecting on now versus then, I think the most important takeaway is that we're even here having this conversation. For a long time in the magic internet money community, we were laughed at. Cryptoassets were worse than tulips. At least with tulips, you got a flower. With this, you get bits on a database. And so the fact that we're having the conversation is heading in the right direction. It's still extremely early. There's lots of opportunity for people to get involved. And so I'll kick it off with talking a little bit about Placeholder, which is where I am now. I remain involved with ARK, but Placeholder is a venture capital firm that invests in decentralized information networks incentivized with the token. We chose a venture capital model as it is a 10-year committed fund, which allows us to really focus on the developers. Even though a lot of these crypto networks have valuations that are in the tens of millions or hundreds of millions or even billions, many of them are seed stage teams that are still facing seed stage problems. And so as a high-touch VC, we come in and really go to work for the network. And now, on to what I'm going to be talking about. If you agree that crypto is a new asset class, which I certainly do, then unique value drivers are going to require new valuation methodologies. And I won't bore those of you in the audience today that have heard me talk about crypto as a new asset class, but I did write a paper on it in 2016 with Coinbase and GDAX, where I go through the many ways in which we can differentiate asset classes. And one of those is value, or are value drivers. And the value drivers are different here, at least for how I think of crypto assets. They don't have cash flows, so you can't value them using a discounted cash flow model as you could equities and bonds. The scarcity is much more predictable and programmable, which arguably gives us a better shot at valuing these than most commodities, and so on and so forth. That said, not everyone agrees with me. So Professor Damodaran, who's really one of the godfathers of modern valuation, wrote in his blog, "I don't believe that cryptocurrencies are now or ever will be an asset class. You cannot value it or invest in it. You can only price it and trade it." So clearly, Professor Damodaran and I disagree. I've exchanged some emails with him. I have a lot of respect for him, and I hope to someday be able to convince him otherwise. To get into that, today we're going to be talking about two kinds of valuation: relative valuations versus intrinsic valuations. So intrinsic valuations or fundamental valuations are really where you investigate an asset in a vacuum, and you're trying to price that asset based on some fundamentals of it, irrespective of what Mr. Market is doing. Whereas with relative valuations, and this is what is most commonly used in crypto right now, you are either pricing an asset based on its historical pricing or relative to other assets. So I'm going to start with relative valuations, and I'll really focus on relative valuations for much of today, because given the nature of the market, it's probably the more useful of the two right now, although over time we will mature and better develop intrinsic methods. The most common relative valuation technique used today is network value. I use the term network value because these are networks with native crypto assets. They are not companies with stocks, and thus I don't use the term market cap. And network value is helpful, but it can also be dangerous. And it can be dangerous if we're not clear about which network value we're measuring, or if the asset issuers in particular are disingenuous about the amount of their token that's currently circulating versus total supply. So to give an example of that, I'm going to show a tweet from Nick Carter, or a couple tweets. So I'll read it. So Monero V is the latest version of something I call the market cap game. He should have said it the network value game, but that's OK. Part of the appeal of these forks is that they get to claim a supply of X million coins, but of course, only a fraction circulate. So they get a glamour spot on CoinMarketCap with minimal liquidity. Why would anyone bid up the price? Because a fat market cap gets you a nice spot on all the ranking sites. And if you do it for long enough, investors FOMO into your coin. It's a marketing strategy, and you have extremely high leverage due to the tiny float. So for example, I could create another fork of Monero, and I could adjust the supply so that there will be 1 trillion Monero tokens. And I may only issue 10 million of those. And if I have enough whale friends, then I can manipulate the price so that it's about $1 a coin. In that case, while the circulating supply may only be 10 million, the total supply would be 1 trillion, at which point I could claim to be the progenitor of the most valuable crypto asset on the market. And it sounds like a joke, but it happens. And it happens more regularly than most people think. I was in an analyst meeting last year with a very reputable team that spoke about how their network value was actually within reach of Bitcoins. And they used their total supply as opposed to their circulating supply. And for many of the analysts that were in the audience, which were traditional financial analysts, they didn't necessarily know the difference. And a lot of people continue to not know the difference. And it's systemic to the point where I'm going to show an example using CoinMarketCap. So with CoinMarketCap, you can rank different crypto assets. They have coins versus tokens. I think they define tokens as a crypto asset that operates on top of another network. And so I'm going to use tokens as the example. And you can rank them by circulating supply, or you can rank them by total supply, which I'm going to do in a moment. And the difference is drastic. So if you look at the top tokens by network value, this is the number 1 rank, 2 rank, 3 rank, 4 rank, and 5 rank. The number 1 rank by circulating supply is EOS at 3.8 billion. And the number 1 rank by total supply is something called Internet of Things coin, XOT, which I'd never heard of, but purportedly has a 30 billion network value. And so I wanted to dig in and say, OK, of these top 5 tokens by total supply, what % of that total supply is actually circulating? And if you go into CoinMarketCap, of the top 5, at least when I ran these numbers on March 16th, I could only find 2 that had disclosures or facts around the circulating supply. And that was Exchange Union and Veritasium. In the orange here, we have the total supply. And in the blue, you have the circulating supply. So Exchange Union has a total supply of 18 billion versus a circulating supply of 12 million. And Veritasium has a total supply of 12.5 billion versus a circulating supply of 250 million. So what does that mean if you're an investor? That means that Veritasium investors can expect a 50x dilution at the whims of the development team, and Exchange Union investors a 1500x dilution. I pulled these numbers from CoinMarketCap. I'm not weighing in on their validity, but this is a very publicly available and highly used resource that I don't think people really have the full context for how to use yet. It's not just the tokens. It's not just the total supply assets. It's also the mined assets where you have to take into consideration the rate of inflation or total supply versus current circulating supplies. So to do that, we can look, for example, at Bitcoin versus Dash. So expected supply inflation over the next year for Bitcoin is about 4%. It's about 9% for Dash. Both of them are pretty moderate. Dash launched in 2014, so it's a younger network than Bitcoin, which launched in 2009. But for example, we can compare that to ZCash, which launched at the end of 2016, and the expected supply inflation over the next year for ZCash, which is about 75%. I'm going to dig into Zcash a little bit more. Before I do, I'm going to say I'm using Zcash because I have a tremendous amount of respect for the team and the network. And the team really welcomes frank discussions. I ran this past Zuko, and Zuko said, thank you very much for bringing a lot of attention to this very important issue. And what I'm going to show is what you can expect the Zcash network value to look like in the future based on inflation plus your expectations around that inflation. Again, using network value as a relative valuation tool. So here's what Zcash's network value has looked like since inception. It briefly crossed the $2.5 billion mark. It's right around in the $1 billion range. And so if we look over the next 10 years, Zcash follows the same supply inflation schedule as Bitcoin, with halvings every 4 years, currently pumping out 50 Zcash every 10 minutes. That'll have after the first 4 years or 210,000 blocks to 25. In another 4 years, it'll have to 12.5, so on and so forth. And so if you expect Zcash to stay, at least when I pulled these numbers, at $300 a coin, this is what you can expect Zcash's future network value to look like. So over there, you're at about 5 billion network value by the end of 2028. Totally plausible, but if you're a crypto asset investor getting a 0% expected rate of return for the next 10 years, you're probably not doing a very good job. And so you want some kind of expected rate of return, and that rate of return should be based on the amount of risk you're taking. So within the equity markets, your expected rate of return is typically about 8%. And so if you were to expect that rate of return from Zcash, by the end of 2028, you would expect a network value that's over $12 billion, which is about 10x from where we are today. Again, totally plausible for Zcash, but just important to think about these expectations, because when people will look at the ranking sites, they'll say, oh, there's so much potential for future appreciation in Zcash because it's so much smaller than Bitcoin, without thinking about the fact that inflation is already baked into your expectations. Now, again, if you're getting an 8% rate of return on Zcash, you're also probably not doing a very good job, because crypto assets are significantly riskier than equities, so you want to be getting a higher rate of return. I typically use somewhere in the 30 to 50% range annually for my discount rates within crypto. If I use the middle of that, 40%, then this is what I can expect the Zcash network value to look like at the end of 2028. So that is right about $200 billion. This is, again, just running a model based on expected inflation, which is baked into the software, and my expectations as an investor. And so what that means is that at a 40% annual rate of return over the next 10 years, you are expecting Zcash to be bigger than Bitcoin is today. Totally plausible, but are you aware of your expectations, implicit and explicit, as a crypto asset investor? Some people will say, well, 40% annual rate of return, that's a lot. That's unrealistic. I don't expect that. If you look at what 2017 was, a 40% annual rate of return over 10 years is about a 30x. For Ether holders in 2017, they multiplied their wealth, if they were able to hold, by about 100x, start of the year to the end of the year. So there's a lot of people, especially if you got involved in 2017, that have come to expect continued asset appreciation like what we had in 2017. Now, 2018 has certainly been a wake-up call. But again, what I'm trying to drive home is that supply inflation and expected rate of return are baked into every future network value. And so if you're using network value as a relative valuation tool, that's fine. You just have to be aware of its strengths and weaknesses. Network value is one tool that's just one number. But a lot of relative valuation tools are actually ratios. And when you have a ratio, you have at least two numbers. And the most common ratio is where you have some kind of price metric, and you're calibrating that price metric for some kind of utility metric. And the most commonly used is network value to transactions ratio, the NBT ratio, also known as the crypto PE ratio. The reason some people refer to it as the crypto PE ratio is if you think about companies as being valued as a function of their profits, then the core utility of a company, at least in the eyes of the stock market, is to pull profits out from the service it creates. Crypto assets, at least how I think of them, don't have profits. They are actually exchanging a native asset, a unit of account, in exchange for the goods or services of that crypto network, and that's represented in the transaction volume. And so in that case, the denominator should be transaction value. And in the numerator, we have network value. So we went through at the start of the presentation all of the assumptions and things we have to keep in mind around network value, and we have to do the same for transaction value, because suddenly we've doubled the complexity to get this ratio. I'm going to break down how NBT is created with some graphs. So if we start with Bitcoin and Bitcoin's network value, here's a beautiful chart, log chart, and the correction hasn't been as big as the media makes it out to be, at least on a log basis. This is what Bitcoin has looked like since it first listed on Mt. Gox, and we had a more or less reputable exchange price. Now, this is the numerator in the network value to transactions ratio. The denominator, the transaction value, looks like this. And already we see, okay, there's some kind of resemblance. So maybe transaction value, going back to what I said about transaction value being the core utility of a crypto network, maybe that is supporting the Bitcoin price. And so we can overlay those two metrics. On the left-hand side, we still have network value, log scale. So we've got Bitcoin over 100 billion. And then on the right-hand side, we have transaction value, log scale. So Bitcoin got close a couple days to processing 10 billion. It's more in the billion-dollar range. And so if I divide the blue line by the orange line, then I get the NBT ratio. And that's what this is. Now, this specifically is an NBT ratio that was optimized by Dmitry Kalichkin. You can search for his Medium post. But what he did is he took the daily network value and divided it by the 90-day trailing average of transaction value. And he writes in his piece why he did that. What I'll point out here is the average is right around 80. And so Bitcoin is right around in that zone. If you look at different NBT ratios, for example, you can go to Coinmetrics and plot this NBT ratio. You can also plot sort of what was the standard NBT ratio originally, which was just taking the rolling average of daily network value divided by daily transaction value. You'll see with that latter ratio, we're actually breaking out, which means these assets are getting pricier because while network value has come down, transaction value has come down more, likely because still a fair amount of transaction value is tied to speculation as traders shuttle assets between exchanges. But I bring it up because even within a single NBT ratio, depending on how you calculate it, you can get different results. This shows Bitcoin and just Bitcoin on a longitudinal basis. But you can also use these ratios to compare across crypto assets. But if you're going to do so, then you have to be really careful about your price and utility metrics, and that the assets that you're comparing merit being compared. For example, when I was a buy-side equity analyst, I wouldn't compare General Electric with Facebook. They're totally different companies with very different business models, with very different growth profiles. And the same goes for crypto assets. And so we can look, for example, at comparing NBT ratios of UTXO-based cryptocurrencies. So UTXO being unspent transaction output, which is the way in which all of these assets keep track of their balances. So actually, Litecoin, ZCash, Decred Dash, and Bitcoin Cash are all originally forks of Bitcoin, some that have been more heavily modified than others. And these, for those of you that are familiar with some of my other work around taxonomies, these are all specifically cryptocurrencies. So a cryptocurrency being something that targets being a universal means of exchange, store value, unit of account, which I would argue most crypto assets are not actually targeted at being cryptocurrencies. The majority right now are more along the lines of crypto commodities. We've got a fair amount of crypto tokens and this new vertical of crypto collectibles. But this, I specifically chose UTXO-based cryptocurrencies. And what we see is, okay, there appears to be this comfortable range in the 20s. You've got Litecoin, which is kind of the silver to Bitcoin's gold, and so maybe that's why it is valued less on a relative basis. ZCash I find interesting, and ZCash, this is actually just for the non-shielded transactions. So ZCash's true NBT ratio is probably actually lower than this because it doesn't include the shielded transactions. Decred is one of your sexier cryptocurrencies going after the autonomous cryptocurrency idea. And then you have Dash and Bitcoin Cash, which are elevated. And when I say elevated, all that means is that if you go back to what this NBT ratio means, takes network value, a price metric, and divides it by transaction value, a utility metric. And so it's saying, okay, on a relative basis of transaction value, how much is the market paying for these assets? So the higher the ratio is, the more the market is valuing that asset. And that can either be because the market is irrational or overpaying for something, or it can be because there's something defensible or something fundamentally different about these assets from the other assets. Something that I've been experimenting with that I didn't have time to put into a chart is you can actually have more than 2 variables within a lot of relative valuation ratios. So for example, I say here, relative valuation ratios don't have to stop at 2 inputs and can value supply side strength too. So just going back, we could calibrate, for example, we could calibrate these NBT ratios for growth metrics. So for example, maybe Dash is growing much faster than any of the other crypto assets, and so if Dash is growing 50% in transaction value or unique addresses, whereas Litecoin is only growing 10%, totally hypothetical numbers, but then if I divide NBT here by 0.5, that would yield 134 for this ratio. And if I divide Litecoin at 23 by 0.1, that would yield 230 for this ratio. And so then actually on a growth basis, Dash would be undervalued and Litecoin would be overvalued. And so that's what I'm trying to get at with we don't have to stop at 2 inputs. And I would call that ratio an NVTG ratio, or someone can come up with a better name, but basically getting into this idea that we can take a existing relative valuation ratio and calibrate it for growth. There are other ideas. For example, there's network value to trading and transacting volume. Historically, I've excluded trading volume from these ratios because if you think about a crypto asset's transaction value as representative of its GDP, then FX, foreign exchange numbers, are excluded from GDP. And thus, I have historically excluded it from the NBT denominator. But for things like Bitcoin and arguably Ethereum, which are the reserve crypto assets for the ecosystem, then the exchange into other assets could be viewed as a purchasing of a good or service with a reserve crypto asset. And so, for example, if you plot Bitcoin's NVTT, it's getting cheaper and cheaper and cheaper over time as it's used more and more and more as a reserve crypto asset. There are others like price to Metcalfe's law ratio. There's a blog by ClearBlocks out there that digs into different variations of this metric that I find interesting. So this, again, uses network value as the numerator, but then different variants of Metcalfe's law, where Metcalfe's law is squaring the number of nodes on a network represents the value of that network. He uses Metcalfe's law for transaction value, but also daily unique active addresses, which I found to be very interesting, and I think people should explore more. And then this idea of you can investigate the supply side. So these three are all demand side metrics to show, okay, how much are people using this network? This capital expenditure to network value is a supply side metric to say, okay, what is the CapEx that's gone into Bitcoin relative to its network value? So what is the dollar amount spent on hardware relative to the dollar value stored. And you could do that across proof-of-work assets. You could also do it for proof-of-stake assets and look at the percent that is staked as a function of the network value. On to intrinsic valuations. So intrinsic valuations is actually something that I'm more interested in than relative valuations. I find relative valuations to be interesting, but it's not the holy grail of the space. Really, I think that either we're totally wrong and we can't intrinsically value these crypto assets, or someone will win a Nobel Prize on being able to really accurately price these things over time. And I think we have a pretty good shot at being able to accurately value crypto assets over time, just based on the fact that all of this data is free, open, and transparent. And the very nature of a blockchain is to monitor value flows with a precision that we really haven't had available within macroeconomic models to date. So the most common intrinsic valuation method, and one that I've put forth for a while, is to use MV equals PQ. So the equation of exchange within monetary theory. And traditionally, the equation of exchange is used to map out the flows of a currency within an economy and how the size of the monetary base changes the pricing of goods within an economy. So on the left-hand side, we have M, which is the size of the monetary base. For example, for the US dollar, monetary base is about 4 trillion. V is the velocity, so the number of times per year that a currency turns over within its monetary base. For the US dollar, it's about 5 right now. So for the US, if you have 4 trillion in a monetary base turning over 5 times a year, that's 20 million in volume that turns over, and that equals this PQ. And PQ, within the way this equation is traditionally used, represents the GDP of an economy, where P is the average price of a basket of goods in that economy, and Q is the quantity of goods in that economy. Historically, how this ratio has most commonly been used is you assume velocity to be flat, and you assume Q to be flat, or at least not mapping to the other variables. And so as you increase the monetary base, so too you must increase the price of the goods, which is represented by price inflation. I use it in an admittedly unorthodox way, where I solve for the necessary size of the monetary base in order to support a crypto economy of size PQ at velocity V. There have been some who have claimed to debunk the use of this equation in this manner. I haven't been convinced. I'm always open to strong and rational arguments, but as of yet have not been convinced and haven't seen a better model put forth. With this PQ, I'm going to dive into that right now and how you can project that. So this is a graph taken from a model I open sourced. If you search Cryptoasset Valuations, it should be the top hit on Google. And within that Medium post, I have an in-depth blog and also this model about a fictitious coin called INET, which represents, again, a fictitious coin within a virtual private network. And within that model, what I do is I project out the price and the quantity of gigabytes provisioned through this VPN network. And the price, represented in blue here, cost per gigabyte, is really just a run-of-the-mill technology cost decline curve. And I think I used a 20% annual cost decline curve. And the Q is a little bit more involved, where you have to make assumptions around the total addressable market, and then the penetration of a crypto network in provisioning that good or resource within that market. And the economy, PQ, will grow so long as your unit growth outstrips your cost decline curve. Now, just because an economy is growing does not mean that the necessary monetary base to sustain that economy has to grow, because we have this big elephant in the room, velocity, which is one of the most important and as of yet still not well understood variables, not only within crypto economics, but within traditional monetary theory. And to give an example, if I hold all other variables constant, but I just play with a velocity of 20 versus a velocity of 50 versus a velocity of 500, the necessary monetary base to sustain the exact same economy looks very different. At a velocity of 20, we have a monetary base that needs to be roughly $350 million. At a velocity of 50, a monetary base just under 150 million. And at 500, a velocity of 500, you have a monetary base that just needs to be a tad over 10 million. I bring this up because these are digital native assets, and that means that the friction to transact them is less than the friction to transact a physical asset. And we're nowhere near an equilibrium stage for these assets yet, but as we get closer and closer to equilibrium stage, I think we will see pretty drastic increases in the velocity of a lot of assets. And so if you're not careful as an investor, you could get caught in these velocity traps where you could have a crypto network that provisions a very large and necessary crypto economy of size PQ, but if the velocity is super high, then the actual monetary base necessary to sustain that economy can be low. And again, monetary base here is synonymous with network value, and to back out the price of the token, you just divide the necessary monetary base by the number of tokens in the float, and if you've projected that out 10 years from now, then you discount back that utility value then to the present to get your discounted expected utility value, which is how markets are priced, or assets are priced. There has been a really noteworthy extension to this theory that I originally put out by Alex Evans. I highly recommend reading this blog. It's called On Value, Velocity, and Monetary Theory, where Alex builds upon what I put forth within my original Cryptoasset Valuations post. And it is involved. It requires reading a couple of times. He also open sourced the model, so you can see that. But his primary extensions were to place a crypto asset in the context of a broader pool, which allows you to decouple the demand for a crypto asset as money from the demand to use it to gain access to the commodity or whatever good or service is provisioned within the network. He also incorporated payment patterns. And what all of this allowed him to do is to endogenously calculate velocity, which is a fancy way of saying the model calculates velocity based on the maturity of the crypto network, as opposed to velocity being an arbitrary input that is indexing off of the little bit of history that we have based on crypto economics. So I highly recommend reading Alex's post. I'm going to wrap up shortly. Before I do, I want to say thank you to all of these data providers who I used in this presentation. They don't make a lot of money from doing this, but it's a really important service. So CoinMarketCap, of course, we all know. Blockchain.info has the best stats out there on the Bitcoin network. CryptoCompare, amazing service. And then also, lesser known, but two newer kids on the block, OnChainFX, who has this great metric that shows network values for 2050. So sort of getting into my earlier discussion. And then also Coinmetrics. So Coinmetrics, I believe you can download on-chain transaction volumes for about 50 crypto assets now, which is really amazing. And they also have ways for you to calculate NBT ratio and compare them across crypto assets. To finish, all models are wrong, and some are useful. And so everything that we went through today is an oversimplification of reality, but one that we use to inform ourselves. And they're more useful than they are dangerous, so long as you're careful of your assumptions, both implicit and explicit. And so I encourage all of us, including myself, to better think about, okay, based on our experiences thus far in the crypto asset markets, what am I overly optimistic about? What am I underestimating? And how is that going to influence future network values? With that, thank you very much. I'm Chris Burniske at Placeholder VC, and I will be signing books if you would like me to sign your book in the coffee break afterwards.